You are the new Gen MFD. Where do you see the value that a mutual fund distributor brings in today's time?
In the late 90s, if a customer invested 1 lakh, they'll personally make 5 to 7,000 instantly. Looking at it today, it will feel like, why was that even there? Today, it's about how do you talk about asset allocation? How do you maybe help the customers plan their financial goals? And most importantly, how do you be the right source of credible information for your customer?
If I am the investor, if I know the person who is giving me advice has different benefits across different schemes, right? So how do I trust that?
There was a bit of mis-selling, unfortunately. Again, bad apples in the MFD ecosystem too.
I'll ask a very controversial question. What is the worst piece of advice that you have heard from a distributor giving to someone? Hi Vishranth, welcome to Power Up Money. Vishranth, when I think about MFD, right, the first image that comes to my mind is this 50-year-old person who has been in this industry for decades at the time when tech was not there. And, when we heard about you, right, you are the new Gen MFD, as I like to say, right? You started your career right after college. So very, very interested in talking and sort of picking your brains on what is your insight into this industry, given the entire gray light around regular funds, mutual fund distributors, etc. Would love to, chat in detail. But let's start with your journey. I think you sort of became a MFD right after you graduated from IIT Madras. Tell us more on your early background.
Yeah, sure, Navda. So, firstly, thanks for having me on here. I've always looked up to the content side of things when it comes to how Power Money has executed. So, happy to be part of this podcast. So, coming to my journey, I would say it's been quite unorthodox. So, I am a mechanical engineering graduate by my major, and similar to a lot of other folks in my college, after the end of first year itself, I realized along with others that mech is not for us. So, we didn't see ourselves making a like a full-time career in mechanical engineering or core engineering in particular. I have done a fair amount of my schooling in Chennai and including my coaching in Chennai, and then eventually moved on to IIT Madras, which is in Chennai as well. So I had a good group of juniors who I had known, and by the end of my first year, a lot of queries started coming in to see can I help them with IIT JEE preparation. How do I understand concepts, especially for mathematics. So essentially, I became a private tutor of sorts by the end of my third semester. So where I used to have anywhere between 8 to 10 students, I was coaching for IIT JEE and CBSE mathematics only. So that is when I started making my money.
Okay.
So even then, I had no idea about investments. And naturally, like any other college student, the first few months went, and I remember buying my first Nokia Lumia. It was very popular back then. Then I got my first MacBook, did a bit of travel, and some sanity set in few months down the line saying that I should consider using the money for something much more productive. And at that point, I happened to get acquainted with someone who's a neighborhood IFA. So today, the terminology is MFDs. Back then, it was an IFA, so independent financial advisor. So we met him at a family function. Somewhere conversation started, and he pushed me quite a bit. And the processes of starting investing were also quite tedious. So he did come to the hostel, collect a lot of forms, checks, etc. And that's how he made me start my first investment in 2013. So it was a very small SIP that I started. So that's what introduced me to the world of mutual funds.
Right.
And eventually, I think this piqued my interest quite a bit because I found it quite fascinating. How do equity markets function? How do mutual funds function? Who's giving the returns? Where is it coming from? And over a period of time, started spending quite a bit of time to research about this online. And by the time I graduated, I was doing an internship somewhere else in a company called Hyperverge. So that's where I met my co-founder, and we both decided, hey, look, there's in India, there's only going to grow. And we both decided to start our own MFD practice. This happened in 2016. So that's how
Got
the
it.
journey has been.
Got it. Very interesting, and as you said, right, very unorthodox too for a I don't know 22-year-old kid to like start the MFD practice, right? I think when I break down and the role that a mutual fund distributor plays, right? I think the first is the whole overcoming the paperwork hassle, right? Because back in the day it was also very tedious to invest, but now tech has sort of simplified a lot of it. The second part is the advice and the literacy part, right? Again, I would say in the last few years, especially COVID and post that, there's been just boom of content or like people talking a lot on the financial awareness and literacy, right? Where do you see the value that a mutual fund distributor brings in today's time?
Sure, Navda. So I'll share one perspective I've been having for quite some time on this. So, see, any industry as it becomes, like as people become more aware about that particular industry, the nature of those intermediaries also will have to be more sophisticated, right?
Hmm.
So, particular to mutual fund industry, what I have observed is in the late 90s, say when you used to have these UTA master share, UTA master gain kind of NFOs, and
Hmm.
you used to get about 7% upfront commission from the investor's money. So
Hmm.
some if a customer invested 1 lakh, the person who has distributed that product will typically make 5 to 7,000 instantly, and that's
Yeah.
deducted from the customer's money. That's entry load, which was
Hmm.
prevalent back then. Um, Looking at it today, it will feel like why was that even there, right? But at that stage in India in 1990s, when
Hmm.
it was all about fixed deposits and PF and post office deposits, mutual funds was way too new.
Hmm.
So at that stage of the mutual fund industry, that is what was the sophistication level required. So someone who could just
Right.
really make some noise about mutual funds, and because the products were not, no one was aware of mutual funds, the person who was doing the job of the sale had to be incentivized quite a bit, hence that 5 to 7%,
Right.
right? But if you see the as the industry grew and as the awareness levels grew among the public, the value that the person adds brings to the table also has to change.
Correct.
So today it's about how do you talk about asset allocation, how do you maybe help the customers plan their financial goals, and most importantly, how do you be the right source of credible information for your customer to
Right.
ensure you are insulating them from all the other noise that is happening in the market and helping them stay invested towards their achieving of their goals. So the role that an MFD play itself has evolved in multifold ways. The
Hmm.
older MFDs, some of the successful MFDs have realized this and they have adopted to the new way of doing business, but many of the other MFDs unfortunately have not. But the newer wave of MFDs who are coming in today, today a 30-year-old MFD who takes up the license or a 25-year-old MFD who takes up the license is very different and understands the need of what he or she will have to do today. So that's how
Right.
I see the MFD space evolving.
Right. And I think some great points, and I would like to double click on a few of them. I think you spoke about the whole generational change, right? Some of
Mm,
the older MFDs,
mm,
how they operated versus the newer ones.
mhm,
What in your opinion, right, and where I'm coming from is because of the commissions and this entire painting the picture of, you earn something when you are selling, right?
mhm,
How I as an investor trust your advice when I know there might be an
mhm,
inherent bias because
mhm,
of commissions.
mhm,
So how did that evolve, and what do you think older generation did wrong?
mhm.
It's painted in such gray light. What's your view on that?
So similar to what I just said, I might not necessarily say what they did is wrong. It is just that the state of the MF industry back then
Hmm.
needed them to do that work, right? But now the industry has evolved. Have the MFDs also evolved alongside the industry is the question we'll have to ask. So primary change in terms of economics, Navda, is 2018 October was a massive change, right?
Hmm.
Where SEBI realized that direct plans were introduced in 2013,
Hmm.
and henceforth a lot of apps came in, a lot of
Right.
good marketing happened, awareness was getting created. 2018 October is when SEBI realized that the nature of commissions and fees paid to the MFDs will have to change. So the
Right.
massive development that occurred was, I still remember, it's 23rd October 2018, if I'm not wrong. Overnight, SEBI came and said no more upfront commissions are allowed. See, what does this mean? So until then, if an MFD say recommended investments worth 1 lakh to a particular client, right? He might get anywhere between 800 to 1000 rupees as upfront commission just for having made the sale, and that will
Hmm.
be credited to him the next month itself. But what main problem this resulted in, mutual funds as a product require customers to be able to stay invested over the long term,
Hmm.
to be able to reap the benefits and create wealth. And actually, being an intermediary, the MFDs also will have to be incentivized to help the customer stay invested. But in this particular scenario, when commissions were upfront in
Hmm.
nature, when someone gets an upfront commission, they are aligned to think, okay, how am I going to make more money by probably, recommending different set of products so that every time a customer invests, I make money. It's more transactional and not a trail fee, not a
Hmm.
recurring fee, right? So SEBI observed this, and unfortunately, at that point, especially in corporates and certain banking institutions, the mis-selling was rampant. So
Yeah.
the practice at that point was a customer comes with 10 lakhs of money, they are recommended a set of products, A, B, C, D mutual funds, and upfront commission has been made. The moment that is done, after 1 year, that's the clawback period.
Hmm.
366th day, this irrespective of the fund performance and the portfolio value, this is moved to a new set of schemes. So another 8,000 or 10,000 rupees is made. So this unfortunately led to a lot of churn because the distributors and the customers' intents were not aligned, right? So
Hmm.
in this way, the customer is never going to make money,
Correct.
right? So I would say it was a massive blow to the industry, MFD industry, but it was a needed cleanup that SEBI
Hmm.
has done. That's I'll have
Right.
to accept that. So post that, what ended up happening, the commission structure is now aligned as all trail, which
Okay.
essentially means the MFDs do not have any instant gratification, or they do not get any fees instantly upon investment.
Hmm.
Only when the customer stays invested for a longer period and their portfolio continues to grow, they get a trail fee, which is a percentage of the value of the portfolio. And
Right.
say that could be today that is standardized anywhere between say 0.6 to 0.8%. Earlier, it used to be 1.5 to 2%, but many investors also do not know that SEBI has instituted this AUM based expense ratio,
Okay.
which
Tell
means
me
that
more on that.
so
Because I was
now
under the impression these expense ratios are of the order of 1.5 to 2%
that
typically.
so I'll explain that now. So what happens is this I believe was in 2019 or 2020, around the same time. So SEBI realized that as a mutual fund continues to grow in AUM, mutual funds charge an expense ratio, right?
Correct.
So they make money off it.
Yeah.
But as the funds scales up, it is the same fund manager who is managing.
Hmm.
So whether the fund manager is recommending 10 stocks for a AUM of 100 crores or 10,000 crores, the stocks and the job of a fund management team is still same,
Hmm.
right? So now gradually as the AUM increases, the benefits of economy of scale has to be passed on to the end customer. So which
Hmm.
means if the AUM increases, expense ratios cannot remain the same, but they'll have to decrease for the benefit of the customer. That's the
Hmm.
right thought process that SEBI instituted those changes with. This basically is very good for the customer
Hmm.
because this ensures that as a fund continues to grow and performs well, the expense ratio continues to slide.
Hmm.
And even for the MFD, the expense ratio sliding means their fees and commissions continue to come down.
Hmm.
So which means today if an MFD is recommending products with a good track record,
Hmm.
for all practical purposes, the AUM of the fund will at least be 10, 15,000 crores because that's when the performance would have already been showcased.
Hmm.
That's when an MFD is supposed to recommend the product to the end customer. And if the end customer enters at that point, their expense ratios are not 2.25, 2.5
Okay.
used to be. It could be anywhere between say 1.25, 1.5, 1.6%. And the
Hmm.
earning of the MFD also is somewhere between 0.7, 0.8, 0.9% at best.
Hmm.
Today, if you look at say the largest funds in the industry, say Parag Parikh FlexiCap as an example, has recently crossed 1 lakh crore,
Hmm.
right? So the expense ratio is not more than 1.2%, and the MFD's payout is not going to be more than 0.5, 0.6%. So
Hmm.
this is very important for the investors to know. There was a point when expense ratios were quite high,
Right.
and MFDs were also paid 1.5, even up to 1.75%.
Hmm.
Today, this has drastically changed. So
Right.
an MFD who is starting their business today and is growing with the investor with a right mix of equity and debt products actually earns anywhere between 0.6 to 0.7% only.
Okay.
That's a reality today, which is not so great for me as an MFD platform, but that is what is good for the customer. And
Right.
now MFDs have to figure out a way to align their business model in order to be able to make reasonable amount of money at this fees and
Hmm.
expense ratio. And most of the customers today, especially in the past year and a half, there is actually a lot of direct to regular switches happening. Even
Already.
on AssetPlus, we had about close to 300 to 400 crores of money over the past so many months that have been switched because customers are saying, look, I have a 10 lakh portfolio.
Hmm.
And now if an MFD is going to actually manage my investments, engage with me, give me the right information, help me do rebalancing, and I will have to pay him maybe anywhere between 5 to 7,500 rupees a year.
Hmm.
It's not so bad. It's
Right.
as long as MFD is transparent and adds value. And the other part here, which I think is a very neat trick done by the regulator, is if an MFD does not retain the customer and by giving him good service, by giving him good recommendations and keeping him or her happy, the MFD actually does not make any money at all. Right? Say someone starts a 10,000 rupee SIP today with an MFD, the trail commission for the first year is not going to be more than 300, 400 rupees. Actually, the MFD is now going to make money only when the investor's portfolio has grown at a reasonable pace to a reasonable value. So it is
Okay.
pertinent for the MFD to continue to offer the best services and work in the interest of the investor to at least help them go to like a 20 lakh, 40 lakh, 50 lakh
Hmm.
portfolio with good CAGR because that is actually when they make money. So I feel
Right.
the cancelling of upfront and reintroduction of pure trail
Hmm.
has completely brought the interest of the customer and the MFDs together.
Right. No, I think totally aligned with this. And we also see a lot of DIY happening around us. My question, and again, taking from an investor lens, right? If I am the investor, if I know the person who is giving me advice has different benefits across different schemes, right? So you mentioned a range 0.5 to 1%, for example, but scheme A gives me 1% trailing versus scheme B gives me 0.5, right? Um, Often it's seen that scheme A will be pushed, which is giving me 1%. So how do I trust that? What's like how does that happen in the distributor ecosystem?
So here, Navda, it will not be right for me to say there's no conflict at all. But the good part from my perspective here is the conflict has been minimized to a large extent. Right? Say today, if you take any good performing scheme, as I said, it could be at 10,000 crores of AUM or it could be 25,000 crores of AUM. The expense ratios are capped and they are in a very narrow range across the fund houses and schemes because of the SEBI's rule.
What's the
Which
typical range like across equity schemes? What would be the range that the trailing commissions would be in?
So I would say any scheme that is more than 10,000 crores of assets, the trail commission will be in the range of 0.7 to 0.8, 0.85%.
Okay.
So this has become so narrow that as long as the MFD is selecting fund from this pool of schemes that are available, it's not that one scheme is at 0.5 and one scheme is at 1.5%, right? So the range itself has become quite narrow. And if the fund continues to perform and say that it gathers AUM and AUM has crossed like 50,000 crores, then all the schemes that cross 50,000 crores of assets will pay 0.5 or 0.6% only. So the nature of the conflict, it does exist to a small extent. It does in almost every business and it does in MFD business also. But SEBI's move has ensured that the conflict has been minimized to a large large extent,
But
right?
is this commission higher on NFOs? Like, so as I understand, beyond a certain AUM size, the delta is hardly anything. So it's in the interest of investor, the best scheme. But for NFOs, is that higher? And that is why we see a lot of like retail money flowing into sectoral and all of these NFOs that happened last year.
That's right, Navda. So going back to the same formula, so when a new fund is offered, the AUM is zero, right? So because it's less than 500 crores of AUM, they can typically charge the highest amount of expense ratio, which tends to be 2% or 2.25%, which also means since expense ratio is high, both the AMC's fees as well as the distributor's fees can be quite high.
Right.
So in fact, there was a bit of mis-selling, unfortunately, again, by certain amount of corporate institutions and maybe some of the, like bad apples in the MFD ecosystem too, where NFOs might be recommended for the sake of commissions. People used to switch from fund A to fund B. That thankfully again has come under the radar of SEBI. And about 4-5 months back, a new circular came out saying that if a scheme switch happens, like from scheme A to an NFO, if scheme A offers 0.6%, NFO offers 1.5%. But because it's being switched from this scheme to that scheme, the fees that is paid out is still lower of the two. So basically, there's no more incentive, thankfully, for the MFDs to switch from something a scheme that's providing lesser fees to maybe a higher fee because they don't stand to benefit anything at all. So I do feel this kind of regulatory oversight is required, and with continuous moves by SEBI like this, the chances of mis-selling are dropping lesser and lesser. So
I think that makes total sense. So I spoke about the role of MFD from tech, the literacy and the advisory part. And we spoke at length about the advisory because I, as an investor, always had that doubt. So I think with the SEBI regulations, I think that gives me more confidence as an investor. But despite all of this, right, we see, for example, in the last 1 year, SIP stoppage ratio still becomes high. Thoda bhi market choppy hota hai, people start withdrawing, right? Where do you see the role of the distributor, or is that, where does it lie? Why is it still not getting stabilized?
So here, there are two parts. Number one is my personal, um, whatever I've seen in terms of data, showcases that a large number of new investors who have entered the mutual fund ecosystem, say over the past 4-5 years, number one, has the expectation been set in a reasonable manner? Is a question we'll have to ask ourselves. Because there has been a raging bull market. Very glad that investors have made money, but it also we need to emphasize on the fact that this is not likely to sustain for a longer period of time, right? So we routinely see conversations between customers and MFDs, or in forums amongst the customers, that okay, fine, I've started an investment today, I'm hoping that it'll at least give me 20-25% CAGR. So that has kind of become the norm, right? What used to be like a 10 or 12%. And when we are in this all the bubble or froth or whatever you could call it, it is quite possible for the investor to reset their expectations to an level that is not the norm. Like it is okay for investors to think, last 4 years or 5 years, markets has given 15, 18%. This is what is going to continue. That is where I think, be it platforms, be it MFDs, it is on them to be able to play the right role in setting the right expectations, showcasing data, planning around more reasonable numbers,
Hmm.
and not, planning financial goals around a 15, 18% CAGR over next 10 years. So I do not think that is being done in an efficient manner. And
Hmm.
to a certain extent, if you also notice, the stoppages that come from DIY platforms are considerably higher than stoppages that come via a human advisor. In India, money is not just money, right? There's a lot more to do with
Yeah,
emotions, and it's
absolutely.
still a developing
Yeah.
country where people don't have that much surpluses that they can be okay with some money just being lost.
Yeah.
So since there's an emotional factor that's always involved, the natural tendency of an investor to listen to a human as a second opinion also
Hmm.
is considerably higher than maybe just a DIY. That's what we have seen. Having said that, it's not that the SIP stoppage numbers via the MFD channel is also 2% or 5%. It is, maybe that could be 70%, but this is also like 30, 40%.
Right.
That is where MFDs also will have to do the right thing by the customer, tone down the expectations, not recommend fancy products just for the sake of maybe keeping the customer excited or earning some extra fees. So there's quite a bit of awareness and right selling philosophies that need to be inculcated. That's
Right.
something we at Asset Plus are trying to do as well.
Yeah, no, totally. And I think that's what we were discussing before we started. And as we were speaking about, before we started this, right? Ki, us as advisors and you as, MFDs, our objectives are same, right? Which is bringing financial literacy, which is helping people grow their money. I think just two different routes. And that is where I, as an advisor, often, question the intention and the malpractices that have happened. And that's why I think a lot of good discussion around the transparency that SEBI has gotten to keep the unethical practices of distributors in check. So I think I'm happy we are having this discussion because it sort of clears the air for me also as an investor and not just from my power up money advisor lens. On that note, in fact, I would love to ask, as you were talking about the generational change, how the advice has changed over the years. You have been in the industry for a really long time, right? I'll ask a very controversial question. What is the worst piece of advice that you have heard from a distributor giving to someone?
Worst piece of advice. This used to be rampant even until 4 5 years back, but now it's reducing thanks to those SEBI regulations on NFO trail commission. Um Unfortunately, some people have perpetuated the a theory that if someone invests in an NFO, because the NAV of the fund is 10, they tend to get more units. So that was at once upon a time used very rampantly by some sort of individual MFDs and corporates also to
Oh.
solicit investments. So if someone has 1 lakh to invest, say there's a very good performing fund, it's been there for maybe 10 years, has a very good track record, but the NAV of the fund is 100.
Hmm.
And NFO NAV always starts at 10 rupees. That's how they are designed, right? So there used to be a selling point to say that, hey, if you invest your 1 lakh in that ongoing fund, which has NAV of 100,
Hmm.
you're going to get 1,000 units. But here the NAV is 10. So you're going to get 10,000. So you know that you will get much more units of sorts.
Oh,
Actually speaking, that logic does not
that's
make any
grossly
has make
incorrect.
no sense
Yeah.
whatsoever, because if 100 rupees NAV of a fund goes to 150 over a period of time, that's 50%. 10 NAV goes to 15 is also 50%, right? So
Correct.
what is a percentage increase is what matters. But I think these were some unfortunate loopholes that existed, and I've seen till today also there is a select set of MFDs who might not have learned and maybe have made themselves as knowledgeable as they should have been.
Hmm.
And this conversation happens, and especially in tier 3 and tier 4 markets,
Right.
I've come across a bit more.
Hmm.
Metro cities is not going to fly much,
Hmm.
but I think that's one of the worst piece of advice that came to my mind when you asked the question.
Right. And on that note, as you said, it's more prevalent in tier three, tier four, and metros. I think there's much more financial literacy. I think I was reading you want to create 1 lakh new MFDs
Hmm.
through Asset Plus, right?
Hmm.
What is your vision of this new chain of MFDs? What should they do, and how does the future look like?
So what I hope to be able to bring in, Navda, so I'll share my perspective. So number one, um, customer centricity and ethics are paramount, right? You will 100% have to do right by the customer. There's no second thought to it. I do feel that the next wave of penetration in mutual funds is going to come via well equipped, digitized MFDs who are essentially not spending too much of time to be able to say take care of operational processes, run around talking to 15, 20 different AMCs and so on, because anything operational to do transactions and reconciliations is a very unproductive part of what an MFD does. So with AssetPlus, we hope to be able to solve that problem by trying to do all the unproductive stuff and automating it on the platform. They focus only on customer acquisition and managing investments. So I feel that the next wave of penetration is going to come from digitally equipped, very ethical MFDs who also will now have to start helping the customer with not just investments but also their insurance needs, right? So MFD is now given the current, for whatsoever the reason that could be, for the penetration levels that we are in today, the fees that is being paid to the MFDs is fairly low. In fact, expense ratios of the funds of in India are in fact much lower than even developed nations like US in many instances, right? But that's a decision that's been taken. We can't do much about it. So what an MFD will have to do is not just rely on mutual funds alone, because the commissions are quite paltry, but it does stack up over a period of time. So being able to service the investments aspects of the customer's financial life with mutual funds, but also being, can they offer advice on, say, term insurance, right? Can they offer advice on health insurance? And with these three products together, can they complete the financial planning bouquet and offer much more value addition than just sticking to becoming an MF distributor alone? And the way in which they do this is also very digitized and super efficient, such that they are not spending their customers' time or their own time, in picking up documents and so on. Everything is digitized, and they engage with the customer by sharing the right kind of knowledge and the fund related information that enables the customer to actually stay invested and create wealth. So imagine having 1 lakh such MFDs in the ecosystem, adding so much value and contributing, and even if each of them are able to manage 150 to 200 clients, right? So that's still about 1 lakh into 200 is just, they handle like 2 crore in clients, or maybe 2 crore families. You say the penetration levels are still quite low. So I would argue that the number of MFDs required for us to reach a sizable penetration level is likely to be a million, if not a little more than that. But 1 lakh is something which we have taken as a vision that we can really work towards and try to create that ecosystem over the period of next 5-7 years.
So, Vishant, what kind of training goes into, teaching these distributors for mutual funds, insurance, and the entire financial planning?
So here, I would divide the training into two parts. So one is very purely certification, right? Because for almost all the financial products today, you need to be qualified enough to provide. It could be maybe an NASM 5A that's required to take up an ARN, or maybe one of the other NASMs to become an RA. So we have a certification oriented training, but our thought process has been that certification is quite helpful to understand the broad theoretical aspects, but actually in terms of the practical aspects of how to talk to customers, how to recommend products, how to handle their conversations, and all the queries that they might have, it is not enough in the current state. So the second kind of training that we provide is kind of on the job training, right? So that involves everything from soft skills training, how do you communicate, how do you maybe develop your brand, how do you present yourself when you go meet a customer or when you talk to a customer, all the way up to what kind of products should you recommend, how do you pitch a product, maybe if you're looking to talk to a customer who's only been doing fixed deposits, right? And you wish to get them to try out mutual funds. You can't go and move that money into, say, small cap, right? You will have to understand their risk profile, gradually give them something that's maybe just one notch higher, keep them comfortable, and once they get the experience and comfort, you gradually take them to the next level. So there's a lot of training that spans across certifications, across the soft skills development, across the market conditions that will translate to products and so on, and in general the sales conversations that an MFD will have to have. And all of these across mutual funds, health insurance, and term insurance. This is what we currently offer. And I think our initiative of AssetPlus Academy that we have started recently, that is a separate vertical altogether, with the pure intent of being able to provide the right kind of training to the MFDs right now, certification, and eventually how to not just be a ARN holder, but to actually be a great and ethical MFD for your customer. And via that, can we create the next 100,000 MFDs is what we are planning to take a shot at.
Got it. No, very, very interesting and very good sort of motto behind it. So, all the best to you to
Thanks.
sort of scale this up. And, when you talk about the trainings, the NISM training, is this one time or is this refresh? It's refresh. Like, how does it work? I'm just curious to know how that is, because I am as an investor, I'm trusting my money for a really long time to a distributor. So, how does that work?
So NISM, we have we have been 100% digital until recently, but we have realized when it comes to training, you cannot have just a online classroom sort of a setting, it will also have to be a mix of online and offline. So all these trainings are offered across three modes. So number one is where everything is pre-recorded and it's available on the AssetPlus platform for anyone who's registered to be an MFD or who is already an MFD also. So pre-recorded sessions, people can consume it at any point, any time of the day when they wish they are available. Second, we also do a lot of live sessions. So the live online sessions basically say for NASM training, we host once every 15 days. So there's about a 10-day, 1 hour to 2 hours per day sort of a coaching for each of the NASM chapters. And that is where, there's an actual trainer who comes on a Zoom call, who takes you through the concepts, who has some dedicated time available for you to ask questions and so forth. That's also the second part of the mode of training we are offering. And third, we have also now started offering the same training offline. So we gather maybe 50, 100 people in particular locations where there's quite a bit of interest in NASM, and then we take up a hall. We actually have a good certified trainer who's there and who helps them in a typical offline classroom setting. So these are the three modes of training, both for certification as well as all the non-certification training that we offer.
Got it. Great, Vishranth. I think we spoke a lot about the industry and mutual fund distributors, their ambitions, their journeys, and the entire thing. Coming to your personal investment journey, right? I think you started your mutual fund investment back in your second year or third year, right? To today, right? How has your investment journey grown over the years? Tell us more on that.
So unfortunately, none of the money I invested back then continues to stay invested, because when we decided to start AssetPlus in 2016, between Amanish and I remember we had about like 2 lakhs, and we were pretty much bootstrapped for the first 4-5 years. So all that went into, thankfully, it's a capital light business. So we didn't have to like raise funds back then. But most of the money, we did not see too much of money in the earlier days. So I still remember in 2020, around the COVID time, is where Amnish and I could draw 10,000 rupees per month salary. And because I didn't have any financial like expertise, I hadn't done any professional courses. It was very difficult in the early stages for me to go convince my friends and family, because they'll be like, hey, aren't you a mechanical engineering graduate? How can I give you my money? So I completed my CFA exams as well.
Okay.
So that was by 2018, I believe. So by 2019, 2020, to the outside world, we are, there's some startup fancy IIT Madras guys and like CFA degrees and whatnot. But actually, we made our first 10,000 rupees a month salary in 2020 June or July. So until then, didn't see much of money. After that, I think we've started taking somewhat of market salaries, and we have started our own SIPs and so forth. But still, from a holistic perspective, most of my personal wealth or net worth is still tied down to AssetPlus stock, right? And this, I do think of this as being much more riskier than even normal equities, right? So which means the financial capital that I have in terms of my SIP and lump sum investment, I would like it to be as conservative as possible. So I have a very, very plain mix of liquid funds, arbitrage, and some conservative hybrid funds, and that's all I intend to do, at least for the next foreseeable future.
Okay, so your entire equity is in AssetPlus, quite
Pretty much
literally.
yeah, that's how it has been so far.
Got it. And you, as someone who's advising, so many people out there, if you were to help our audience with their mutual fund selection framework, what would that be?
So what is one structure I've seen that works very clearly, right, for younger audience especially, similar to all these MFDs, etc. Mutual funds as a whole do not have a concept of instant gratification, right? Which is both the good and the bad. The good is you don't get instant gratification, but it steadily compounds more predictably than a lot of other exotic asset classes, and it can result in a sizable portfolio. So for many of the youngsters, I have seen not having instant gratification is like a big negative for it when it comes to mutual funds, right? So now when it, from that perspective, if I see, a satellite and a core approach typically works best. So when youngsters come in and they select products, it is perfectly okay for about maybe 75 to 80% of the portfolio to be in a core portfolio approach, right? Where you select products that have performed extremely well, that have a great track record. Maybe if you strongly believe that overperformance compared to benchmark is not there, you can throw in a couple of index funds. You can have a bit of hybrid funds, because there are a lot of good hybrid funds at very less expense ratio that really add value. You can mix up some liquid funds, ultra short term funds as necessary. Keep it as plain and vanilla as possible, and this should likely take care of your financial goals, which are very, very critical. But at the same time, it's also important for the investors to maybe have a 10% or a 20% part of the mutual fund portfolio, which is like a satellite approach, right? So this could be, you wish to take some aggressive bets in some particular themes. You feel that maybe a particular sector has, really gotten beaten down, and you wish to, ride the wave. These are more tactical selections to take. So doing like an 80% core 20, which is mostly vanilla products, and 20% satellite, which has some bit of exoticness of sorts, will really help, keep that kick in mutual fund investments. Because if 100% is going to be vanilla, it's very, these days youngsters want something very like a little class, something exotic, something that can really give you 40-50% returns, and this 20% is something that they can play around with. And I do not feel it is right to say you should have everything in vanilla, because then either for the advisor or to the platform, the customer will say, yes, I'll have everything here, but secretly they'll maybe do a 50,000 investment in a crypto, or they'll be doing an FNO. So they might as well, I think, accept the fact that some variety is needed for human nature, and
The kick.
80-20, the kick and 80-20 approach typically works very well.
So let's talk more on the 80%, the core portfolio. You mentioned a couple of funds, indexes and hybrid. Could you, for context, our audience is this 30-year-old out there who is working in a metro city and planning for being financially free in their 40s. What would that core portfolio look for a person like that?
So first point of the conversation for portfolio construction should be goals, right? So, and that typically starts with maybe a contingency or emergency goal, and then you list down all your short-term goals, maybe 5-year, 7-year, 10-year goals that you have, and longer term goals, maybe for your daughter's education or for your retirement corpus, like 15-20 years down the line. Once the goals are very well laid out, depending on the duration of the goal and how important it is for you to be able to achieve that goal, you arrive at an asset allocation for it. So emergency, 100%, you can't have any equity at all. It has to be fully as safe as possible. So liquid and overnight funds do a great job there. But if you say the goal is maybe 5 years away, right, then you could consider having a 40% asset allocation and maybe debt. 60% could be in conservative hybrid or aggressive hybrid, or even a bit of large cap or small bit of large cap and flexi cap thrown in. So maybe a 10-year goal can have a 75 equity, 25 in debt, right? So finalizing the goals is step number one. Step number two is being able to come with rough asset allocation that will work best for those goals. And then within the asset allocation, product selection is actually the very, very last step. Right. So in many cases, investors try to start off with the product selection first. That I do not feel is the right approach, because that's the process of construction of the portfolio starts from your financial goals. So at the end of the day, if you are deciding not to use the money to spend on yourself and family, and you want to save for the future, the least you need to be able to know is, okay, what use do you see for the money in the future? So that's how the financial goals come in. All of this is great in paper, but I'll also have to accept that today, if an FD investor for 5 years they've only invested in FD, they have seen a MF Sahiye campaign, and they're like, okay, let me try out a 2,000 rupee SIP. To this person, if you go and put this process, he or she is going to run away, right? So I think that's where the nitty-gritties will have to be managed, and it has to be really personalized. As much as this is the right process for an ideal mutual fund investor, it is not going to apply for someone who wants to test out mutual funds with 2,000, right? So then, is that person testing out because they want to know the risks, or is that person testing out, do they want to know the possibility of better returns? Understanding of that person's thought process, recommending and giving regular information, feedback on the portfolio performance, the trust has to be gradually built. But for an ideal investor, goals followed by asset allocation, then followed by product selection, then the investment journey starts, and regular rebalancing. It could be 3 months also slightly aggressive, 6 months or 12 months rebalancing, keeping in mind the product performance, the taxation. That is usually a simple process that does the trick.
Right. No, as you rightly said, I think all of this applies to someone who is more seasoned in terms of okay with the volatility. So I often say ki if you are starting off, just start with index to know how market moves. Just be okay with the ups and downs, and then we can figure out the entire process. So I think the process really helps. And product, as you said, is the last part. And people often start with that, oh, iska expense ratio itna hai, and all of that. But in terms of product selection also, because there are, if you go to any category, suppose I want to do mid cap, right? There are 10 funds out there, even the good performing, right? Is there a framework that you use for selecting, the right fund within the category?
So some of the so the framework also will differ for each investor, but a broad set of parameters that can be used to gauge is what I can comment on. So number one, the fund will have to have a track record,
Hmm.
right? Because very simply put, if you compare one fund with a 5 year or a 10-year track record and something that doesn't have much of a track record, the reason to invest in the latter fund has to be so strong that you're ready to do it without data. Maybe there's some really kick-ass fund manager. Sorry for the usage of the word, but if there's some really good fund manager who you like, and that person has started off and launched a fund, maybe you could
Hmm.
consider taking a bet. But it's like very off cases, right?
Hmm.
So in most cases, the track record of the fund, which also means not just an absolute performance, but the performance as well as performance over the benchmark, is very critical to monitor.
Hmm.
And a minimum of a bare minimum 3 years, advisably 5 year, 7 year performance track record is pretty good. And in comparison of returns, also it should not be point to point returns,
Hmm.
because the point to point returns just is a statistic that can really be
Absolutely.
you can look at any data points and convince yourself of literally anything you want, because the markets
True.
are quite volatile, right? So generally a rolling return based analysis helps quite a bit. And once you have looked at all these from a returns perspective, on the other side, the volatility of the fund, the Sharpe ratio, beta, not required for everyone. Either the platform can do this or maybe the MFD or RA can do this. But these are also points to be considered. And here, one of the important factors is the downside capture ratio,
Hmm.
right? Because at least in the Indian context, what really worries a good number of investors about mutual funds is it does not have the word guaranteed in it,
Hmm.
right? So the risk when you involve when you invest in a mutual funds is fairly higher than any of the other products, fixed income products. So as an investors do not like volatility as much. So
Right.
if maybe a 1 lakh rupee portfolio is going to come down to 60,000, but eventually it gives a healthy 12% over a period of time,
Hmm.
versus a 1 lakh comes to maybe 30,000, but it can possibly give you 15%. On paper the second is better, but when you factor in the human emotions, the first
Right.
always works better. So downside capture ratio is like a very critical parameter we advise people to look at. And the lesser the volatility and the better the downside capture ratio, the better it is for from a product
Hmm.
selection perspective. So these are some of the parameters. Depending on the sophistication of the investor and their experience, they could choose to add a lot more qualitative or quantitative, but whatever I've told pretty much I feel covers the basics of what needs to be done.
Right, right. No, I think the framework really helps, Vishrant. And let me move to the other part of the portfolio, which was the satellite, which is,
Mhm.
taking certain bets on themes,
Mhm.
etc. And I would, in general, want to ask, given you have been in the industry and, you have a much clearer understanding of the market,
Mhm.
where do you think are the, growth pockets in India's market in terms of themes and overall in general? Where do you see the Indian markets headed for the next 5, 10, 15 years?
Indian mutual fund industry does have a host of other investment options apart from your regular, like your vanilla, flexi cap, and so on, right? So thematic or sectoral investments do attract a fair bit of interest. And over the past 3 to 5 years, if you see, all see when you introduce a fund, it has to come as an NFO,
Mhm.
right? When if you say NFOs are absolutely bad, then no fund will exist today, because every fund today was an NFO at some point,
Hmm.
right? So when do you recommend the fund is much more critical than the fund just having an NFO tag. So many good sectoral themes sectoral investments have come in over the past 5 7 years. Today, if an investor say wishes to take a particular bet on maybe IT sector, or maybe they wish to invest in pharma or something in terms of manufacturing, a decade ago these options were not available at all. So
Hmm.
what the investor would have to do is try to handpick stocks of their own, and then if they handpick the stocks, are they going to maintain 10 stocks in the sector with 10% allocation? How will they rebalance? It was a nightmare, right? So the um, so many sector funds having come in is one possible option that investors can consider as part of their satellite portfolio. But
Hmm.
that again does not mean it is okay to say that India has a great growth story, like a very good demographics, a developing country, GDP is increasing, all that is great. But it also that cannot translate to saying every single sector is going to grow
Hmm.
for 10 years, so why don't you go and invest? So some bit of research will have to go into, okay,
Right.
what are the prospects for the sector, what is the current valuation that particular sector is in, what have been the trends, and maybe having some conversation with fund managers will help, taking some views, independent views from the markets, or maybe their RAs or MFDs will help. A lot has to go into taking a decisive bet on, okay, amongst all the 10 12 sectors that I can invest in, maybe these are the two sectors that will really work out the best. And
Hmm.
let me maybe allocate 5% of my portfolio towards this sector for my long term goals and 5% towards. That's a reasonable take. Say
Right.
gold is an example. Say gold and silver have done extremely well in the past couple of years.
Yeah.
In some sense, gold also can form a part of both the core as well as the satellite portfolio, right? So if you see that there's a large opportunity for whatsoever the reason you feel that gold is going to do well, it's okay to maybe put in a 10-15% of your lump sum investments in gold or silver or commodities in general for that matter. So
Right.
the opportunity to invest in these themes and sectors which was not there 10 years back is there today, but the sophistication required to understand where to invest is quite high, and it's not meant for all retail investors because these are bets that can go horribly wrong also.
True.
There are sector funds that drop like 50% in 6 months, right? So
Exactly.
and most investors, as much as they think they would be like to they will be in a position to stomach the volatility, actually will find it very difficult, so you'll have to
Right.
be quite careful.
Right. And I was reading, I think it was a sectoral fund news only, that AUM always chases the returns. So, for
Yeah,
example,
that's right.
defense, yeah, infra,
Mm,
whatever
mm,
PSU it was last year, so much money came into that, and then all
mm,
of them crashed.
that's right. Yeah.
So none of the investors made money
So that's very
ultimately.
ironical, right? So that's what is a very funny thing when it comes to the sector fund performance. When the past 3 or maybe 5 year or 1 year returns have been very poor, in general, you could say that it has been poor because the sector is not is valued less.
Hmm.
But investors who choose to take decisions on investments will look at the past performance. That's all they have to see. So most of the investors, by human nature, if they see that one fund 1 year returns is minus 30%, will be like, this is absolutely the worst fund. Why am I going to invest in that? So in most cases, the probability of that performing better is higher. But on the other side, as you rightly said, so many of the sectors have given 50%, 100% returns, which means today, if you look at those sectors, they are highly valued. And the investors who invest today might make that mistake that just because 2024 to 25 returns is 100%, they assume it means 25 to 26 is also 100%.
Right.
What they will have to realize is it just indicates that had you invested in this particular fund in that particular date in 2024 and stayed invested for 1 year, you would have made 100%. But hey, there's no guarantee at all on what the next year returns are going to be. So it's very ironical that performance comes. Large number of retail investors look at past performance and enter. That swells up the AUM. So most money in that fund ends up being invested at very high valuations,
Exactly.
which is again a cycle, which means the next 2-3 years performance is very poor. Most of the investors will be like, this is an absolute, like a
Yeah.
bad fund, and why did I get into it? So
True.
this is where I think that rationalization of emotions and
Right.
explaining all of these concepts in the right manner is very
Right.
much required for most investors.
Right. And that is why I think that is exactly where the role of advisors and distributors come in, right? To build in that sort of sense into what makes sense to invest and what doesn't, right? That's the true value add that all of us are doing ultimately.
I would, in fact, I will have to accept platforms also add the same amount of value. Just that the say for an platform to add this value, the customer will have to be very sophisticated,
Yeah.
right? So as and when there are very well learned investors who know and who probably have reached that zen state in terms of understanding volatility and so on, they just need to be able to see the data and for them to take the decision themselves. And platforms can do a good job there. Even maybe at some point in the future, there will always be a certain set of investors who do not need an human advisor at all, right? And
Yeah.
platforms have a role to play. Market is so diverse that MFDs have a role to play, RAs have a role to play. I think
Yeah.
everyone will, as long as they work towards the benefit of the customer, I feel there's a good part of the pie for everyone to have.
Absolutely. I think that's the perfect note to end this podcast on, Vishranth. And I think thank you so much for taking out the time. So much learnings, and I had a lovely time.
All right. Thanks, Navit. Thanks again
Thanks.
for having me. Happy to have had this chat. Very insightful.